Hello and welcome to this edition of Tax Gurucool. I'm Advocate Harsh Kothari, and in this video, I'll be dealing with the amendments made by the Finance Act 2023 insofar as they relate to charitable trusts or institutions. Section 11(1) provides that income derived by a person from property held under trust only for charitable or religious purposes shall not be included in the total income of such persons, subject, however, to fulfillment of certain conditions prescribed therein. The definition of the term charitable purpose is found in Section 215 of the Act. Finance Act 23 has made certain amendments in the Income Tax Act which will affect trusts or institutions claiming exemption under Section 11 of the Act. Similar amendments have also been made with respect to funds, trusts, institutions, universities, or hospitals which claim exemption under Section 1023C, subclauses 4, 5, 6, and 6A. However, for the sake of convenience, in this video I'll make reference to the sections dealing with trusts or institutions claiming exemption under Section 11 of the Act. We may first look at Section 12A, which states that the provisions of Sections 11 and 12 shall not apply in relation to income of any trust or institution unless the person in receipt of income satisfies the conditions stated therein. One of the important requirements as per Section 12A(1) for claiming exemption under Section 11 is that of registration. The requirement of registration of trust underwent a major change after the enactment of Taxation and Other Laws, Relaxation and Amendment of Certain Provisions Act 2020, TOLA, with effect from 1st April 21. Clause AC was inserted in Section 12A(1), requiring a trust or institution to make an application for registration within the time specified therein. Section 12AB was simultaneously inserted by TOLA to lay down the procedure for fresh registration. Now let us deal with the subclauses of Clause AC. So subclause 1 of Clause AC of Section 12A required a trust or institution which was already registered under Section 12A or under 12AA to make an application for registration within 3 months from 1st April 21. On receipt of application, the Principal Commissioner or the Commissioner of Income Tax was required to pass an order registering the trust for 5 years. Subclauses 2 to 5 require certain trusts to make an application for registration within the specified time limit. Subclause 2 covers trusts which are already registered under 12AB and the period of the said registration is due to expire. Subclause 3 covers trusts that are provisionally registered. 4 deals with trusts whose registration has become inoperative due to first proviso to Section 11(7). Subclause 5 deals with trusts that modify their objects which do not conform to the conditions of registration. And finally, subclause 6 is where an amendment has been made by the Finance Act 2023. So prior to this amendment, subclause 6 stated that in any other case which did not fall within subclauses 1 to 5, the trust or institution was required to make an application for registration at least 1 month prior to the commencement of the previous year relevant to the assessment year from which the registration was sought. So if a trust sought registration from assessment year 22-23, that is previous year 21-22, such trust was required to apply at least 1 month prior to 1st April 21. The consequence of this provision was that if a new trust was set up in the middle of the year, say in October 2021, such trust would not be able to claim benefit of Section 11 for the first year of its setup, that is previous year 21-22, because it was required to make an application for registration 1 month prior to 1st April 21. Further, as per the Act, prior to Finance Act 23 amendment, such trust making an application under subclause 6 would get a provisional registration for a period of 3 years. Now, there are two amendments which have been made by the Finance Act 23. One is insofar as the amendment in subclause 6 in clause AC to section 12A(1), which now provides that where the activities of the trust or institution have not commenced, then such trust would be required to register at least 1 month prior to the commencement of the previous year, relevant to the assessment year from which the said registration is sought. However, insofar as trusts which have commenced their activities, they can make an application at any time, subject, however, to the condition that such trust has not claimed exemption under Section 11 or 12 or under Section 1023C, subclauses 4, 5, 6, and 6A for any previous year ending on or before the date of application. Section 12AB has also been amended to provide that the trusts which have not commenced their activities will continue to get a provisional registration for a period of 3 years. However, the trusts which have commenced their activities, the principal CIT or the CIT will conduct inquiries and, if satisfied, pass an order granting registration for a period of 5 years. One of the other requirements prescribed in Section 12A1 for applicability of Section 11 is that a return of income must be furnished within the time allowed under Section 139. Finance Act 23 now specifies that such return of income must be furnished within the time allowed under Section 139(1) or 139(4). Consequently, a trust will not be able to claim exemption under Section 11 on the basis of an updated return filed under Section 139(8)(a). We then come to Section 12AB4, which empowers Principal Commissioner or the Commissioner to cancel the registration of a trust if he is satisfied that some specified violations have occurred. Specified violations have been defined in explanation to Section 12AB4. The Finance Act 23 has expanded the meaning of the term specified violation to cover even a case where an application for registration of trust is incomplete or which contains false or incorrect information. The next amendment is with respect to Section 115TD. Section 115TD imposes tax on trusts or institutions registered under Section 12AA or 12AB and on funds, institutions, trusts, universities, hospitals referred to in Section 1023C, subclauses 4, 5, 6, and 6A. On the happening of certain events specified in that section, when one of the events which attracts Section 115TD is the conversion of the specified entities into any form which is not eligible for grant of registration under 12AA or under 1023C. Finance Act 23 now provides that if the specified trusts do not make an application for registration as per Section 12A 1 AC, subclauses 1, 2, and 3, or as per the relevant provisions of Section 1023C within the specified time limit, then such trust will be deemed to have been converted into a form not eligible for registration and will attract the provisions of Section 115TD. We then come to the amendments in Section 11 dealing with application of income. As we know, Finance Act 21 inserted explanation 4 in Section 11(1) to provide that application for charitable or religious purposes from corpus or from any loan or borrowings will not be treated as application of income. However, it was at the same time it was also provided that such amount would be treated as application in the subsequent year in which the amount which was not earlier treated as application is invested or deposited back out of the income of that subsequent year into a mode specified in Section 11(5), which is specifically maintained for corpus, and similarly where such amount which was not treated as application is used out of the income of the subsequent year for repayment of loan or borrowings. Now, certain additional conditions have been inserted by Finance Act 23. Firstly, the requirement is that the investment or deposit in a mode specified in Section 11(5) for corpus or for repayment of loan or borrowing must be done within a period of 5 years from the end of the previous year in which the application was made, from the corpus or from loan or borrowing. The second condition is that the application from the corpus or from loan or borrowing must not have been made on or before 31st March of 2021. The third condition which has been now prescribed is that there must not be any violation of other conditions at the time of making application from corpus or from loan or borrowings. The instances of these violations are, for instance, firstly, that the application must not have been made towards corpus donation in the earlier year to any registered trusts or institutions. Secondly, the requirement of Section 40A1A and 40 capital A 33A must not have been violated in the earlier year. Thirdly, the application must have been made in India except with the approval of CBDT under 11(1)(c) at the time when the application was made in the earlier year. The next amendment by the Finance Act 23 is with respect to donations made to other trusts. As we know, prior to the amendment, entire donation to other registered or approved trusts, other than a donation towards corpus, was treated as application of income for charitable or religious purposes. However, from assessment year 24-25, such donation shall be treated as application only to the extent of 85% of the amount of donation. Finally, we come to the last amendment made by the Finance Act 2023 with respect to filing Form 10 and Form 9A. As we know, Form 10 is filed for accumulation and setting apart of income, and Form 9A for deeming certain income to have been applied. Finance Act 23 now provides that Form 9A and Form 10 are to be furnished 2 months prior to the date for filing the return of income under Section 139(1) of the Act. These, in brief, are the amendments made in respect to trusts or institutions which claim exemption under Section 11. As I said earlier, similar amendments have also been made with respect to trust funds, institutions, universities, or hospitals which claim exemption under Section 1023C, subclauses 4, 5, 6, and 6A. Thank you for watching this video. The PPT is available in the description tab.